Picture this, it's 2025 and Kenya's economy is struggling. Inflation is biting, jobs are disappearing, and many Kenyans are barely making ends meet. Yet, in the midst of all this hardship, Kenyan banks are posting record breaking profits over 100 billion shillings just in the first 6 months of this year. How is this possible? Are banks thriving while the average Kenyan suffers? And why does it feel like the system is designed to keep you poor? Today, we are diving deep into the world of Kenyan banking, pulling back the curtain on their massive profits, and exploring why, just like in the game Monopoly, banks seem to never run out of money, no matter how tough things get for the rest of us.
Some of my friends wengi sana hawana job.
Karibu everyone, I'm Kevin and today we are tackling a question that's on many Kenyans' minds. How are banks making billions while the economy is tanking and people are losing jobs? In the first half of 2025, major Kenyan banks like Equity Group, KCB and Cooperative Bank reported staggering profits. Equity alone made 34.6 billion, KCB 32.3 billion and Cooperative Bank 14.1 billion. Meanwhile, the World Bank has downgraded Kenya's growth forecast to 4.7%, and unemployment is a growing concern. So what's going on? Are banks profiting at our expense? To understand this, let's break it down step by step, and I'll even throw in a little game of Monopoly to explain why banks always seem to come out on top. Let's set the stage. Kenya's economy in 2025 is facing serious headwinds. The World Bank reports that GDP growth has been revised down to 4.7% from 5%, citing fiscal challenges, high debt levels, and inflation pressures. Inflation has made basic goods like unga and cooking oil more expensive, squeezing household budgets. The Central Bank of Kenya notes that private sector credit score is at a 5-year low of 1.3%, meaning businesses aren't borrowing to grow, and jobs aren't being created. Non-performing loans that borrowers can't repay, have hit a worrying 16.7%, the highest in 18 years. This tells us that Kenyans are struggling to pay back loans, likely because of job losses and rising costs. Think about it. When businesses can't borrow, they can't expand. When they can't expand, they don't hire. And when they don't hire, people lose jobs or can't find them. In 2020, the number of Kenyans with over shillings 100,000 in savings dropped for the first time in 13 years, and that trend hasn't fully recovered. The CBK reported that 97% of bank accounts hold less than 100,000 shillings, showing how wealth is concentrated among a tiny elite. So while ordinary Kenyans are struggling, how are banks still raking in billions? Let's talk numbers. In the first half of 2025, Kenyan banks collectively made over 100 billion shillings in profits. Equity Group led with 34.6 billion, a 17% jump from last year. KCB followed with 32.3 billion Kenyan shillings, up 8%, and Cooperative Bank posted 14.1 billion, an 8.4% increase. Even smaller banks like Family Bank saw profits soar by 38.8% to 2.28 billion. How are they doing this? Three main strategies stand out. First, banks are lending heavily to the government. Kenya's government is in a fiscal crunch, borrowing heavily through treasury bills and bonds. These are low-risk investments for banks, offering high returns, sometimes over 10%. For example, Family Bank's income from government securities nearly doubled to 3.4 billion shillings in 2025. Second, banks are charging high interest rates on loans. Despite the CBK cutting its benchmark rate to 11.25% in December 2024, banks are still charging 12 to 15% or more on loans. Compare that to the 2.5% they pay on savings accounts. That's a massive profit margin. Third, digital lending platforms like M-Pesa Fuliza and KCB Mobile Loan are generating huge fees and interest. In 2018, FinAccess reported that digital borrowers took 25 million loans, 8 per borrower. These short-term interest loans are a gold mine for banks. But there is a catch. While banks profit, borrowers are drowning. The interest rates and fees on digital loans trap many Kenyans in a circle of debt. And when you can't repay, banks seize assets or blacklist you with credit bureaus, making it harder to recover. Meanwhile, banks are cutting jobs to boost efficiency. Digitization, like WhatsApp banking and mobile apps, means fewer staff are needed. Equity, KCB, and others have reduced branch staff, contributing to job losses across the sector. Let's talk about Monopoly, the board game we all know. In Monopoly, the banker controls the money supply. No matter how crazy the game gets, players going bankrupt, properties being mortgaged, the bank never runs out of money. It just prints more or redistributes it. Sounds familiar? In real life, banks play a similar role. They control the flow of money, decide who gets loans, and set the terms. And just like in Monopoly, they always come out on top. Here is how it works. In Monopoly, the bank collects fees, interest, and penalties. If you land on someone's property, you pay rent. If you can't pay, you lose assets. In Kenya, banks are the same. They charge high interest on loans, hefty fees on digital transactions, and penalties for late payments. Even when the economy tanks, banks don't suffer. They pivot to safer bets like government securities or raise loan rates to cover risks. In 2024, posts on X highlighted this sentiment. One user said, "The only businesses making profits are banks. They loan to a broke government and make huge interest." Another pointed out that banks aren't hiring because they don't need your savings. They are profiting off government debt. In Monopoly, the banker doesn't care if you go broke. As long as the game keeps going, they are fine. Kenyan banks operate similarly. They thrive on your debt, not your wealth. When you take a loan, they profit from the interest. When you default, they seize your assets. And when the economy struggles, they shift to low-risk, high-return investments like government bonds. The system is rigged so banks never lose, just like in Monopoly. So why does it feel like banks want you poor? Because their profits often come at your expense. High loan rates and digital lending fees hit low-income Kenyans the hardest. The Central Bank of Kenya reported that lending to agriculture and real estate dropped significantly in 2021, meaning banks are avoiding riskier sectors that could create jobs. Instead, they focus on safe, profitable ventures like government lending or digital loans with 20 to 30% interest rates. This keeps money circulating among the wealthy, banks, government, and big corporations, while small business and individuals struggle. Here is a relatable example. Imagine you are a small trader in Gikomba market. You take a 10,000 shillings digital loan to restock your store. The interest rate is at 1.5% per month, plus fees. If you miss a payment, penalties pile up, and soon you owe double. Meanwhile, the bank's balance sheet looks great, but you are deeper in debt. This cycle keeps many Kenyans trapped, unable to save or invest. And with 90.1 financial inclusion in Kenya, thanks to mobile banking, more people are exposed to these high-cost loans. It's not that banks are evil. It's that their business model thrives when you are borrowing, not when you are thriving. So, what can we do? First, get financially literate. Understand loan terms, interest rates, and fees before borrowing. Second, explore alternatives like SACCOs or Chama groups, which often offer lower rates and community support. Third, push for policy changes. The government could regulate digital loan rates or incentivize banks to lend to job-creating sectors like agriculture. Finally, save and invest wisely. Even small amounts in a money market fund or government bonds can grow your wealth over time, reducing reliance on loans.